Yes, sir. Good morning to our esteemed NRIs joining from us from Kenya. On behalf of Ashutosh Financial Services Private Limited, I, Premji Fufal, extend a warm welcome to each of you for this insightful and focused webinar on India 2025 and beyond, regulatory trends and investment opportunities. We are truly honored to have you with us today for the webinar that has been specially curated for the NRIs in Kenya to provide clarity on India 2025 and beyond, a focus session on emerging regulatory changes, strategic goal investment planning, and the growing opportunities through GIFT City funds to help you build and diversify your wealth effectively. Today's session will focus on three key areas: cross-border taxation and India's financial regulatory landscape, strategic investments planning for global NRIs, GIFT City funds, a powerful new avenue for NRI investments. This webinar has been organized with the overwhelming support of Mr. Ketan Patel, who is a property lawyer and developer in India. Now we will begin today's session with an introductory video of our esteemed speaker, Mr. Daxesh Kothari, and CFP, Mr. Rajit Kothari. After that, we will dive into the core presentation of the day. Following the presentation, we will open the floor for a Q&A session where you can share your questions in the comment section and we will address them. Please don't forget to provide your valuable feedback after the session through the link which will be available in the chat box. Without taking much of your precious time, let's kickstart today's event and enjoy an enriching learning experience. Thank you.
Mr. Daxesh Kothari is a tax and financial consultant and the Managing Director and CEO of Ashutosh Financial Services Private Limited, which is an ISO 9001-2015 certified company with prominent presence in the field of financial services. He specializes in the fields of income tax, FEMA, trust laws, estate planning, and foreign tax compliances. On the financial front, he specializes in investment services and insurance services. He advises companies, trusts, high net worth individuals, and non-resident Indians across the globe on financial and tax and allied laws related matters. He is a trustee of various charitable trusts. He has been involved with a number of social service projects of Rotary Club and is a Paul Harris Fellow of Rotary International. He has been presenting analysis on the Union Budget since last 16 years and also on various subjects of taxation and finance at various forums addressing doctors, businessmen, industrialists, taxation consultants, chartered accountants, company secretaries, NRI and postgraduate students of diverse branches on subjects related to finance, taxation and estate planning to make our society financially literate. His articles on financial subjects are regularly published in renowned newspapers like the Economic Times, Mint, etc. and also in magazines like The Lal Street. His interview was aired on ET Now as a mutual fund industry expert in the program named Swatantra, which is one of the most acclaimed investor education initiative of our country. He has also addressed a program dedicated to NRI on a leading Gujarati TV channel in Ahmedabad. He is a 360-degree versatile personality in the fields of taxation and finance, which makes him a unique and truly a one-stop solution provider for wide range of financial and tax-related matters. Mr. Rajit Kothari is the Executive Director of Ashutosh Financial Services Private Limited, which is an ISO 9001-2015 certified company with prominent presence in the field of financial services. He is a chartered accountant and a certified financial planner by qualification. Further, He has graduated in the field of commerce with specialization in banking, financial services and insurance sector from Ahmedabad University and has also pursued post-graduation in the field of law. He started his journey with Ashutosh Financial Services Private Limited, where he played an instrumental role in functioning of several business development activities of the company. He also played a vital responsibility in the development of exotic product offerings for the company in the alternate investment arena such as foreign equity and unlisted stocks. Moreover, he was instrumental in the preparation of extensive knowledge database on different topics concerning taxation and finance for the company. Thereafter, he worked with Messrs. Deloitte Haskins and Sells LLP, one of the leading global consulting firms at Mumbai, focusing on tax and regulatory compliance for high net worth resident and non-resident individuals. He is an expressive public speaker and addresses professional forums on diverse topics related to finance as well as other topics of national importance. He has participated in international exchange program as a student and has also attended management development programs across top business schools in India. As a young and dynamic director with a multi-skilled personality, he presently concentrates on exploring innovative business opportunities through geographical expansion, digital proliferation, and concentric diversification of the company.
Good morning to everybody, all the friends in Kenya, and a warm welcome to this presentation. The topic of our presentation today, India 2025 and beyond, regulatory trends and investment opportunities. The moment we look at any kind of investment opportunities or any country for any meaningful exposure in terms of any financial investments, the first and foremost thing which comes up in the minds of anybody is that what is the health of the economy in which we are contemplating investments. Yes, we all being persons of Indian origin, we are quite in touch with whatever is happening in our homeland, in our motherland. But there are certain aspects where we need to understand exactly how the country is moving and how the economy is moving. The first and foremost thing when anybody looks at any country is what is the kind of growth which is happening in that country. When it comes to India, yes, India even in 2025 continues to be amongst the fastest growing economy, amongst the top 20 economies of the world. And today, in terms of GDP size, it is the fourth largest economy. And in another 2 to 3 years, it is all set to become the third largest economy only after the US and China. So this is the kind of growth and this is the rate of growth which is happening in India. Every day, day in, day out, in all kinds of media and conversations which are going on, everywhere in the world, we hear that what is the kind of action which US is taking and what are the announcements that US is making in respect of every country. Yes, India is also a country which is impacted out of the US tariffs. And when it comes to India, India has been inflicted upon a tariff rate of 50%, which is the highest rate of tariff akin to Brazil. And this is, as I said, is the highest rate of tariff which has been inflicted to any country or set of countries by the US. The sectors which have been impacted on account of these tariffs are majorly the sectors which are basically labor-intensive sectors. Yes, those sectors and the people who are associated with these sectors would definitely get impacted, but they are a very small part of the Indian economy. The sectors which have not been impacted are very important sectors, capital-intensive sectors and growth areas, which are generic pharmaceuticals, electronic goods, which are all these iPhones and Samsungs, which are manufactured in India, and last but most important, IT services, because IT services are services and not in the ambit of tariff. So these sectors, despite having a large share of exports to the US, have not been impacted. There have been talks which have been going on with the US to iron out the differences and reach to an agreement. But till now, we have not been successful to arrive at a deal or a settlement on the trade issue. One of the major factors which is rather stalling the arrival or finalizing of the deal is that India is very clear that India would not compromise on its national interest and succumb to any kind of pressure. And this is something which is a matter of pride for every Indian who is anywhere in the world. And this is the kind of strength which India can portray, that we will arrive at an agreement, but at terms where our national interest is not compromised. It will have its own time and it will take its own time. All those viewers who are of my age, they would remember the famous dialogue of the film Dawn, which said that Dawn ko पकड़ना मुश्किल ही नहीं नामुमकिन है. And in respect of the President Trump, it would not be out of place to say कि Dawn को समझना मुश्किल ही नहीं नामुमकिन है. Because every day there is some kind of an announcement, some kind of a thing which crops up, and nobody would have expected that. But that is what it is, and India has to face it. But I would say India is quite equipped to face it. And the Indian government is quite cognizant, prepared, and laying out different things very articulately to see that the Indian economy is in its full bloom. There are three major things which have happened in India in last 6 to 8 months, alongside this tariff noise which have been going on. The first is that on the direct taxes front, which is the income tax front, the government has reduced taxes. The rates of tax and the minimum threshold, it has increased. So to the extent of 4 lakhs of rupees of income in India, there is no tax, and the maximum rate of tax of 30% will be applicable only after you have an income in excess of 24 lakhs of rupees. So everywhere in the world, there is a scenario where the rates of tax are increased, or in one way or the another, government will try to collect more taxes, while as in India, government is going to forego 1 lakh crores worth of taxes to see that there is a liquidity in the hands of the people at large, so that consumption and savings are encouraged. Before Navratri, government came out with measures to reform the goods and services tax. India had a 4 rates structure of 4 rates of tax. It simplified the structure to just a 2 rate structure. Then the rates of GST, which is the indirect tax in India, has been reduced, benefiting lot of citizens and businesses on several goods. This has led to a boost in consumption in the economy. And this Navratri, the day from which these lower rates of GST kicked in, this was the best Navratri in terms of sales in last several years. These were the measures on the fiscal front by the government to see that the economy is up, moving and running. And on the monetary front, the Reserve Bank of India in last 1 year has reduced its interest rates by 1%, which is 100 basis point. And today the repo rate, the rate at which the central bank of the country, the Reserve Bank, will lend to the commercial banks has been reduced to 5.5%. Inflation in India is very much in control, and the last inflation noted was just 1.5% of inflation. So fiscal policy and monetary policy are in align with each other to see that consumption is boosted in the economy. Moreover, consumption is also boosted by the entire shift of the unorganized players to the organized players, and a massive spend by India to the extent of 11 lakh crores in the development of infrastructure by the government. So all these things would definitely boost consumption and would see that the wheels of the economy are moving, and thereby the standard of living of the individuals in the economy gets improved. Insofar as the demographics of the country is concerned, India continues to be a population of youngsters, and youngsters would lead to being a large energetic workforce and also a force which will also be big time consumers of goods and services. This is a prerequisite for any economy to grow. When it comes to governance in India, the quality of governance is par excellence. There is a stable government in place. The fiscal deficit for the budget which was presented for the year 25-26 financial year is just 4.4% of GDP. And last year, this fiscal deficit was 4.8% of GDP. This is despite lot of reliefs given under different tax laws and very substantial infrastructure spending. The capital markets in India are transparent, and the regulator is considered to be one of the best regulators globally. The public sector in earlier years, before 15-20 years, it was considered to be an area where government would lose money and has to fund the losses year on year. Now this public sector is one of the big drivers of the Indian economy, and they have been granted a lot of independence, and the productivity of the public sector is at its very good health. The central bank, the Reserve Bank of India, not just as a bank which would announce the best of the monetary measures which we have already discussed, but as a central bank of the country, they have been monitoring the financial systems in the best way, and it has been respected as one of the best central banks in the global arena. As far as the political and the geopolitical might of India is concerned, we all Indians can be quite proud about the fact that India today has its own might and own voice. It has got friendship with everybody, but not aligned to any superpowers, and it pursues its own economic interests. Financialization and digitalization are the buzzwords in India in every sector of the economy. The data cost, the mobile data and the internet data that we use in everything is one of the cheapest in the world, and that acts as one of the fluid for supporting financialization in the country. UPI transactions, internet related activities, and the entire ecosystem on digitization is at its peak. Infrastructure is something which we hear every day. Last week we heard, or rather this week basically, we heard that India is now having a major new airport in the form of the Navi Mumbai airport. Every day we hear about new roads, new airports, and new railway lines installed everywhere in the world. Any part of the country, right from east to west and north to south, you move, you will see that there is a lot of infrastructural development which is happening in India at a very rapid pace. And this is in a country which is a democratic country where there are so many impediments, but India is able to work through all these impediments and see that infrastructure is at its peak, which is going to be the base for the economic development. Manufacturing all these years was, rather would say that, ignored as a part of our growth strategy. Now, manufacturing in India is picking up. Our ties with countries like Russia and China are improving out of each other's enlightened self-interest. All these countries know what are the kind of limitations which they would face in terms of their relationships, but India is able to work out common grounds in mutual interest. Offshoring and China plus one strategy is something which is leading to manufacturing of sophisticated equipments and sophisticated electronic goods, which is the new norm of manufacturing in our country. Lot of capital expenditure is happening on the manufacturing side, and manufacturing as a share of our total GDP is slowly but steadily quite improving. The stock market performance in last 1 year in India has not been encouraging. But if we look at a 3-year perspective and compare it with different markets in the top 20 economies of the world, then Indian stock market performance on a compounded annual growth rate basis is quite creditable. And when anybody takes any exposure in equities, one should look at a longer term performance rather than looking at just a 1-year performance on any stock market. Last but not the least, and very important, rather I would say the most important thing, that Indians are very confident about their economy, because it is these Indians who are going to drive the country and drive the economy. They are very confident about the Indian economy. And the proof is that from the year 2015 to 2025, the foreign institutional investors in 2015 were 23% of the Indian stock market. So of all the entire market capitalization of the Indian stock market, 23% of the stocks were held by the foreign institutional investors. Slowly and steadily, they have moved out of the country, going to their own country or investing somewhere else. Their share is now 17%. On the other hand, the domestic institutional investors, which includes the mutual funds, insurance companies, in 2015, they were just 13% of the stock market, and today they are 18%. And this is supported by a major inflow of investments in the Indian stock markets to the route of systematic investment plans in mutual funds, wherein on a month-on-month basis, and if we look at the figure for September 2025, the figure stood at 29,000 crores of investment, and that is a month-on-month investments. So, with the passage of time, Indians are becoming more and more confident about the economy, and they are the people who are going to drive this economy. So, this speaks of the way the country and the economy is moving, and it would not be out of place to say that India is definitely an resurgent economy in 2025 and continues to be in the times beyond. Now, the further part of the presentation, I would request Rajit to take it forward.
A very good morning to everyone who have joined from Kenya. Moving forward with today's presentation, and starting with the regulatory trends that are shaping the Indian economy in 2025 and beyond. Let's first start with the tip to transact in India in any form of any financial activities, which is banking. As far as banking is concerned, most of us already know that the NRIs who are residing outside of India, they are not allowed to hold resident Indian savings account. The resident Indian savings account will be either closed or converted into the NRO account. The NRO account is a non-repatriable account, meaning funds cannot be directly moved outside of India without undergoing a certain particular procedure which is laid under the law. It is basically the interest income on this account is taxable, and it can be held jointly with any other resident, and a loan can also be availed. NRO as well as this NRE account are rupee denominated account. NRE is a freely repatriable account, meaning funds can move outside of India without any kind of legal procedure that has been prescribed. The interest income is completely tax-free. Whatever arises in the NRE account, a loan can be availed, and it can be held jointly only with a relative. FCNR are a form of deposits that can be held with Indian banks, and they are in other currencies, not in INR, in certain specified currencies. And the interest rates are also dependent upon the type of currency that we are going to and opting for. The interest income in this deposit is also tax-free. And a loan can also be availed, which is a form of planning that many of the NRIs are doing, wherein they borrow in Indian rupees and invest into the Indian financial markets or any other venture, so that they are not exposed to foreign currency fluctuation. And at the same time, they can participate in the growth of the economy. A common question that we receive from a lot of people is that we know that NRO account is a non-repatriable account, but if we have funds that are lying in the NRO account or are likely to be credited into the NRO account from sale of certain proceeds of any investment or through whatever sources, then can we move that into the NRE account or outside of India? The answer to that is yes. The funds from the NRO account can be moved to the NRE account to the extent of 1 million US dollars per individual per Indian financial year. The only requirement is that whatever are the taxes that are there on the receipt of the funds in the NRO account, the taxes should be cleared. And then there's a certification by a chartered accountant in a prescribed format that needs to be submitted to the bank, disclosing the source of the fund through which the funds can move from the NRO to the NRE account. Aadhaar card and OCI card. These are two important documents which a lot of people living outside of India of Indian origin are often confused about. Let me clarify and clear all these myths and confusions that are there. As far as the Aadhaar card is concerned, firstly, any person who is an Indian passport holder, irrespective of their stay in India, are eligible to obtain an Aadhaar in India. Apart from that, if there is a foreign passport holder who does not have an Indian passport, then the person should have stayed in India for a period of more than 182 days in the preceding 12 months. So today, if we are looking at, let's say, the 11th of October, then 10th of October or 11th of October 2024 to today's date, there should be a stay of more than 182 days, irrespective of the OCI or any other status. If this is fulfilled, then the person is eligible to have a Aadhaar. As far as the OCI is concerned, then it is mandatory basically to enter into any kind of financial activity in India, predominantly into Indian financial investments or real estate investments, or the person has to prove that the person is eligible to obtain an OCI card. Only then a person can be investing into the Indian financial markets. Recently, few years back, the government mandated all the PAN card holders, meaning all the persons who are holding a PAN in India, to link it with their Aadhaar card in the income tax portal. This is only for those who already have Aadhaar card or who obtain an Aadhaar card going forward. They are supposed to link it in the income tax website with the PAN. If a person is not having Aadhaar or is not even eligible to have Aadhaar, then it is not mandatory to link it. They are exempted from this requirement. And this is a major confusion, kind of myth that many of the NRIs have, and then we often hear them saying that we do not have Aadhaar card, so we cannot do anything in India. That is completely a myth. There is no compulsion to have Aadhaar in India. It is not mandatory to obtain Aadhaar in India. And if your PAN has become inoperative on account of non-linking it with the Aadhaar, then we can resolve it. The only thing is that we need to prove that you are an NRI living outside of India and you are not eligible to obtain Aadhaar. This way, we have sorted several cases of inoperative PAN. Now, what is a PAN? I think most of you who would be having any kind of asset in India would already be knowing about this. But let me reiterate what are the situations when a PAN is required. It is required for all these different kind of activities in India. In simple words, if you want to enter into any kind of financial activity in India, then it is a taxpayer identification number, and it is a mandatory requirement to engage in any financial activity in India to have a PAN. Moving forward with taxation, how does taxation work for the Indian incomes of any non-resident individuals? Firstly, a basic concept which we need to understand is that any income which accrues, arises, or is received in India is liable to tax in India. What I mean to say is that if you are living outside of India, but if you directly receive any kind of income in your Indian bank account, then that is liable and subjected to be taxed in India. If you are living outside of India and if you just simply repatriate those incomes from your individual bank account to your Indian bank account, and if you are a non-resident under the Indian income tax, then there is no tax implication merely on transferring those funds. Who is required to file an income tax return in India? Even this is a very common question that comes across a lot of people. Many people also think that if they have a PAN, then it is mandatory to file a return in India. That is not true. The only requirement to file an income tax return in India is in these situations that when your Indian income exceeds 4 lakhs of rupees during the financial year, beginning this year, if you want to claim refund of taxes that are deducted, or there is TDS which is done, and if you want to claim refund of that, in that case, a return will have to be filed. If you want to claim a loss, meaning if you have a loss from a sale of a property or any other investment, and if you want to set it off against any other incomes in future years, and if you want to carry it forward, even then a return is mandatory to be filed in that year. If you do not file that income, if you do not file a return, and if you have incurred a loss, then you cannot carry it forward for set off against other incomes in future years. Or if you have entered into any kind of significant financial activity in India, the entire list of the different activities I have mentioned, even then you need to file ITR in India. This is another common question that we receive, that if I do not have any kind of refund that is arising, and if the TDS that has been done against my income is sufficient to cover up the tax liability, then do I need to file a tax return? The answer to that is yes. Even if you are not having a kind of refund that is arising, if there is no payable that you have to the government, but if your income exceeds the basic threshold of 4 lakhs of rupees, then return filing is mandatory, and the income tax return will have to be filed in the prescribed format before the due date of filing. Double taxation avoidance agreement is also something which is very important and is worth identifying and understanding. Firstly, let us understand as to how is this DTAA between India and Kenya relevant to you. Now, as an NRI, whatever income that you have in India will have to be offered for taxation in India, and taxes will have to be paid against those incomes, as we have mentioned in this slide in the second step. Thereafter, in the third step, since you are a tax resident of Kenya, then ideally the global income may have to be reported in Kenya because it's your tax residence country. And then whatever taxes that you pay in India can be availed as a set-off or credit against the taxes that you have to pay in Kenya. So only the excess tax over and above what you have already paid in India is subjected to taxation in Kenya. And this is a benefit of the Kenya DTAA, wherein whatever taxes that you have paid in India are available for a credit or a set-off, and the excess amount, if at all there is anything, then that amount is subjected to be paid in Kenya. The another important benefit is that for all the NRIs, the India-Kenya DTAA has got several tax exemptions and benefits on incomes that they have from India. So any NRI has got two options. They can go with the taxes that are there in the Indian income tax law, or with the concessional rates of tax that are there in the India-Kenya DTAA. Whichever is beneficial to them, they have an option to opt for that. So this is the entire list of incomes in which they have a beneficial or a concessional rate of tax that has been mentioned in the treaty, the TTAA, for any incomes that they have in India as compared to the rate of tax in India. Let's say if it is mutual funds, then it is taxable at the rate of whatever is mentioned. If it's on equity, then it's 12%, 12.5% for long term, 20% for short term. Similarly, for debt, there are different rates of tax. And for pension and dividend interest incomes, it is taxable at the respective rates of tax. But because of the India-Kenya DTAA, there are concessions which are there, wherein most of these incomes which we have mentioned, which is income from sale of mutual funds or pension, is not subject to any tax in India, only if a certain procedure is carried out, which I'll explain you in the later part of this presentation, or if there is an income out of dividend or interest, then there are concessional rates of tax which the Indian government will charge, considering the DTAA exemption. This is the procedure to avail that beneficial rates of tax, wherein we have given an example of anyone who is holding mutual fund investments in India. And if that person who is staying in Kenya sells that mutual fund investments in India, be it equity or non-equity, then naturally the mutual fund companies will deduct the TDS, and then a tax residency certificate will have to be obtained from the Kenya Revenue Authority. This TRC, along with the Form 10F, needs to be submitted to the Indian Income Tax Department online, and a income tax return needs to be filed along with the 10F and the TRC, basis which the refund of the TDS will be issued to them, and whatever taxes that were deducted by the mutual fund companies will be refunded to the taxpayer. This has also been supported by several case laws, including a few recent ones, And this is a laid and an accepted position in Indian law, wherein this DTAA benefit is available on mutual funds. Now, moving to the next part from taxation is estate planning. We all understand the importance of participating in the resurgent Indian economy that we discussed in the earlier part of today's presentation. We all have inherited assets that are there in India in any form. But have we ever thought as to how will the succession trigger? What will happen when there is a person who dies, and how will the succession of the assets happen, which is very important to understand. Now, firstly, the succession of all the assets will happen as per the laws of succession in India. If the asset is situated in India, the succession mechanism is in two parts. For all the assets where the person has made a will, which is called testamentary succession, the succession will happen in accordance with the will. And where a person has not made a will, then it will happen as per the Hindu succession law, which is applicable in most cases, or any other religious law, as the case may be. This is a common misconception which is there with so many of the people, that whenever we talk about the importance of making a will, then the natural answer to that we receive is that we have already made nomination on all our investments and all our assets. So it is fine if we do not make the will. We must understand here that a nominee is a mere custodian, but the right or the title to the ownership happens according to the will. And if the will is not made, then it is happening according to the personal law, succession law that is applicable, which is the Hindu Succession Act or any other law as the case may be. To give you an example, if there are assets which are held in India, which a person wants to bequeath to a certain beneficiary who could be the owner's son or a daughter, and if there are multiple children that are there to that investor or that person who is holding the asset, and if the person has made that son or daughter as the nominee of the investments, thinking that the person, the son or the daughter, will get access to his assets in his absence, then the person will definitely get access, the son or daughter will get access to the investments. But because there was no will that is made, the succession will happen in accordance with the Hindu succession law, in which the spouse as well as all the children will have an equal share in all the assets of the person who has deceased, and the siblings of the son or the daughter, meaning the other sons and the other daughters and the spouse, can challenge that son and daughter and claim their own share out of the assets that are the person is getting by being a nominee. So a will is important if we want the assets to pass over to certain specific legal owners, beneficiaries. Whenever we explain the importance of this the way I did to any person, then the immediate response that they would have is that I understand the importance of making a will, and I will surely execute it the next time which I come to India, which could be after a long period of time. We must understand that a will can also be prepared outside of India, meaning a person living in Kenya can very well prepare a will sitting there. The only thing is that it should have all the essentials of a valid will, meaning it needs to be signed by two witnesses and it should be in presence, ideally in front of a notary public there. And the witnesses should also give affidavits, meaning legal declarations that they were present while the will was being prepared. It is prepared in front of their eyes in full state of mind by the person who was making the will. Shifting to the second part of the presentation, which is the investment opportunities in 2025 and beyond. How can any person living in Kenya, any NRI, participate in the so-called resurgent economy that we discussed about? The most simplest and the convenient means is to invest in the mutual funds. There are two equity mutual funds in India, wherein there is a financial profile of the investor basis which the portfolio is designed. And it is also in considering the risk appetite and the goals of the investor. It is the most popular means of investing in the equity market today that the entire India is accepted. And the mode of regularly investing through systematic investment plan is also a very effective and accepted route. uh, the ideal mutual fund portfolio should have appropriate distribution across all these categories that we have mentioned, which is large and mid, flexi, multi, so on and so forth. It should also have a proper concentration across different mutual fund companies. And the while selecting the mutual fund schemes, comparison with the benchmark like Nifty, Sensex, or the applicable benchmark and the quartile performance are very important parameters that we must consider in selecting the portfolio and the scheme of mutual funds. This is an illustrative example that we have indicated, considering the key performance indicators, the entire data matrix of all the schemes that are there, which we prepare by recommending a mutual fund scheme to any investor. And we should take into consideration all these parameters, which is portfolio turnover ratio, meaning the number of times the portfolio of the stocks has churned in the last year, the past returns, the sectors in which they are investing, the bifurcation across large, mid cap. There are even further parameters to be evaluated and considered to select a mutual fund scheme, but we have simply presented this for the purpose of illustration. Once an investment is made, it is also very important to review the portfolio on an ongoing basis. And if at all there are any changes which are likely to be made in the portfolio because of either the reasons of performance or because of certain other changes that are shaping up in the economy, then those changes need to be made so that the portfolio is dynamic and remains agile. So we review all our portfolios on an ongoing basis to ensure this. Moving with the second route of investing is portfolio management services. His PMS is basically a similar kind of an investment vehicle like a mutual fund, wherein there is a professional fund management by the asset management company which is there. And the concept is same of wherein there is a professional who manages the fund. And there is a diversified equity portfolio, but it is in a separate brokerage account. A earmarked demat account, which is the brokerage account in India, is created by the asset management company in which the shares are bought and sold in the name or the ownership of the investor, but which stocks to buy, what price to sell, what price to buy is the job that is outsourced to the asset management company. The way we can select the scheme in a mutual fund, we can also select a scheme in a PMS. The way it is different than a mutual fund is that number one, there is a concentrated portfolio which is there, meaning a PMS comprises of generally 20 to 40 stocks, while a mutual fund comprises of 50 to 100 stocks or beyond. Because the portfolio is concentrated, then naturally the chances of return generation are higher in the longer term. The second manner in which it differs is that the regulatory restrictions which are there in case of a PMS are much lower than a mutual fund, because in a mutual fund there are several restrictions like a stock specific cap or a sector specific cap that are there. Well, in case of a PMS, there aren't these kinds of restrictions. So the portfolio manager has got a free hand to take any kind of bets that he or she might see fit. And lastly, the inflows and outflows of other investors in case of a PMS does not impact the overall pool, while it affects in case of a mutual fund because it is a common pool, and the inflows and outflows of other investors also has an impact on the investment. So because it is a separate demat account, inflows and outflows do not affect the portfolio. And the minimum ticket size for this is 50 lakhs of rupees as per present regulatory requirements. These are all parameters that we consider to evaluate any PMS scheme and recommending any kind of PMS scheme. The way we can select and bifurcate in different mutual fund categories, we can also split the 50 lakhs ticket size into two different strategies. Moving beyond the shores of India comes global investing. And we all know the kind of growth that the global investing has delivered in the recent past. So, to give a global opportunity of investments to our investors, we have developed a platform which invests into US stocks and ETFs. And this is all possible through a broking partner that we have in US called DryWealth, and a custodian. The custodian is Citibank. It is a very interesting fee model when there's a fixed fee and there are no other charges which are there. And the funds can be remitted directly from Kenya to US, and there are no financial implications of India that are there, meaning there is no taxation of India that is involved if the funds move directly from Kenya to US, and the entire transaction can happen between US and Kenya without involving India. This is the snapshot of that platform which we have developed. These are all the portfolios that we have curated, which are all based on the recent themes of EV, the big tech companies, the other companies which are going to be proxies of the kind of changes that are going on in US, the deglobalization, the space tech, cybersecurity, AI, which we are all aware of, and many other different themes that we recommend. Certain practical insights that I wanted to share with everyone right now. Number one is a common question that we receive is that uh, should we invest in real estate in India if we are living in Kenya? There are certain pointers which we need to keep in mind whenever we are selecting any kind of a real estate investment. Because firstly, liquidity in terms of selling a real estate property at the desired price within a desired time can often turn to be a little difficult, and managing a real estate property may also be difficult if it is not selected appropriately. And the entire process of investing, disinvesting, and remitting requires time and efforts. So that needs to be considered whenever we are investing in any real estate property. In many of the cases, the next generation is not keen to relocate to India or even to manage the real estate property. Even in that case, we need to consider the property appropriately whenever we are selecting any real estate investment. And if we are looking to self-use the property of real estate, then it makes good sense. But from investment perspective, we need to consider all these options whenever we are selecting a real estate property. Depreciation of currency. This is a very big concern which a lot of investors have. Now, if we look at the depreciation of Indian currency against the Kenyan shillings, it has been only 1% on a compounded basis in the last 10 years. So it isn't as high as we often understand it to be. If we look at the depreciation of the Indian currency against the US dollars, and it has been 3% on a compounded basis. But looking further from now, depreciation of currency, as we know, is dependent on two factors, which is the inflows and outflows and the differential of inflation. Then the inflows in India have started to improve in terms of the direct foreign direct investments as well as the institutional investments. And the inflation difference is also narrowing now, which is why the depreciation going further may not be as high as what has been witnessed in the past. Gift City is a very interesting development that has happened recently in India, and I'm sure all of you would have come across this at some or the other place. Now, this Gift City is an international financial service center, one of its kind, and is basically like any other global financial center, like Singapore, Hong Kong, Dubai, or any similar such kind of a center. And the idea is that the Exchange Control Law of India, FEMA, is not applicable in this area, which is the special economic zone. And there are a lot of benefits which are there for financial services activity. In terms of the Income Tax Act, well, all other laws are applicable. This is how any person outside of India can participate. Wherein any NRI or any foreign national or any company in the Gift City, company outside of India can invest in the Gift City funds, which are called as the alternative investment funds. which would invest in the Indian mutual funds or the stock exchange. Whenever this kind of a entire route is followed, this is like a funnel arrangement. So all these mutual fund companies, they have started their alternative investment funds in the gift city. So they pool the money in that fund and invest in the same mutual funds that we have been investing not since few years but decades altogether. Then there are no tax implications either at the fund level or even at the investor level. Then there are no, because there is no tax implication, there is no requirement of obtaining a PAN, of filing a return, or entering into any kind of tax assessments in India. There's also no requirement of opening a brokerage account or a demat account or routing it through the Indian bank account. So the funds would move directly from Kenya to the gift city and back. These are all USD denominated investments. So the currency advantage is also there. And the onboarding is very simple. So to summarize, this is how it would work. Wherein the investment is in the gift city, AIFs, which would invest in the Indian mutual funds, which invest in the equity shares. And the gain, whatever arises, is completely tax-free, can be repatriated seamlessly. The advantage is that there are no tax implications which are there. The uh, there is no requirement of any bank account, demat account that is required, or the investments are denominated and the investments are denominated in USD. This is a recent message from a prime minister at the World Leaders Forum, which emphasizes on the kind of reforms that have transpired in the last 10 years and beyond. So this is the new Bharat, which is regularly and is in a new avatar altogether, full of different kinds of reforms, keeping in mind the Indian investor living in India and also outside of India, like all of you. A disclaimer that all these views were personal, and wherever we have used any data, we have used the references. A glimpse of our event that we had recently in Kenya this May earlier. And we were fortunate to meet so many of you in person. We would be happy to do these kinds of initiatives even later on a digital basis and going forward on a physical basis as well next year onwards. A brief about us and what we do. We have a legacy of more than 65 years being a one-stop solution provider with a team strength of more than 60 people, comprising of all different domains of experts from all different domains of finance, with active office presence across the western belt of India in the cities of Ahmedabad, Rajkot, Gift City, and Mumbai, cumulatively managing more than around $125 million of assets, predominantly in the Indian markets and also in the global markets for more than 5,000 individuals spread across 26 countries. The services that we provide to everyone is number one, investments, complete investment portfolio management in India in all the avenues like mutual funds, PMS, AIFs, alternates, private markets, as well as the US market. Gift City, we already have our office in Gift City, and we provide a lot of advisory on investing in the Indian markets through the route of Gift City. Complete Indian income tax compliances, right, from obtaining a PAN to handling tax assessments and advising on Indian tax planning. Estate planning is also something which is very important for all the assets in India. We help in preparation of wills in India, also private trusts, insurances, because we're insurance brokers, so we deal with all life insurance offerings. International tax compliance is also very important because we help in taking benefits of the DTAA, as I mentioned earlier. Financial regulations, meaning repatriation of funds or any kind of other financial activity in India, is also something that we advise. And of course, coordination with the bank. The advantages for anyone who is working with us is that there's a single point of contact for anything and everything that they can think as far as Indian financial affairs are concerned, which is all possible through a relationship manager from our team. And this brings a lot of convenience to the person who is working with us and also to us in terms of giving a holistic advisory, discharging all the tax compliances. Now, as far as our charging mechanism is concerned, all these other services that I mentioned are all complimentary from our side as long as the investment portfolio is managed by us. If any one of you happens to visit any of these locations, it will be a pleasure to meet you in person. Thank you for sparing your valuable time, and the entire presentation, along with the recording of this video, will be available to you over WhatsApp or email, whatever you have provided while registering for this webinar. And we look forward to more and more such sessions. Thank you for sparing your valuable time on this weekend, this festive weekend especially. And if you have any questions, we'll be more than happy to answer.
Yes, Rajit sir, thank you so much. So there are a couple of questions which are mentioned there in the chat box. So we'll take up one by one. So number one is by Mr. Kirit Shah, and he's asking that can he prepare a will here in India, and if he can further provide him some the necessary steps which need to be followed while going for a will to be drafted in India.
Sorry, could you please repeat the question? I did not understand the initial part.
It is with regards to preparing a will from India.
Okay, got it. Yeah, so definitely we can prepare a will in India while you are in India or while you are in Kenya. We can coordinate for the documents that are required, which is predominantly the assets that you have in India and all the members of your family and whomsoever you require and you have planned to bequeath the assets. All these things can be mentioned. As I mentioned, the only thing is that you need two witnesses and the will needs to be notarized by the notary public. So it needs to be signed in presence of the notary public, and there needs to be affidavits that needs to be obtained by the witnesses.
Thank you. I request to all the participants, if everybody is interested to have a one-to-one discussion with the speakers, then they can just raise their hands from the chat box and from the application, and we'll unmute them so that they can ask their questions as well. Moving on to the second question, which is by a participant with regards to the investments into Gift City. So he's asking that how many funds like AMCs which are available, and then what is the minimum ticket size which allows to onboard the investments into Gift City.
Right. So there are about around 10 different asset management companies which are reputed ones in the Gift City right now, which have started their funds in the Gift City. The minimum ticket size for most of these funds is 150,000 USD. There are a few retail schemes which have recently started, but there aren't much options available for that. So for the minimum ticket size for most of these investments through the Gift City and mutual funds remains to be 150,000 US dollars.
I also request to all the participants if they can help us with their feedback through the link which is provided there in the chat box. And I request if somebody wish to clear any of the doubts with regards to their Indian financials, they can please let us know through the chat box, through a message in the chat box. And if they wish to directly interact with the speaker, then also it is possible. So we'll wait for a minute or so before we move further. I think Mr. Kothari, you can proceed with the ending remarks. Thank you.
Special thanks to all the friends from Kenya who have joined today. And looking forward to more and more such interactive sessions to spread knowledge to all of you. And thank you once again for sparing your valuable time.
And now there are a couple of questions. So if you allow us, then we can take them as well.
Sure, yeah.
Okay. So the another one is with regards to the TRC, whether it is available in Kenya or not. So if you can please.
Yes, there is TRC which is available in Kenya, and there is an entire process to obtain a TRC that is mentioned in the KRA website. So you can follow that process and obtain a TRC for you for that year.
Right. And Mr. Parikh, Amit Parikh, wish to know the taxation on the disposal of the property in India.
Right. So I think there's another part to the question that also is raised. So I'll answer both. Whenever a property is sold in India, then the rate of tax is 12.5% plus surcharge plus cess, depending on the amounts. If the property has been held for a period of more than 2 years, so this is going to be the the rate of tax on the capital gains that will be arising. So this is the rate of tax, and there's no indexation benefit that is available. So basically, whatever is the rate of the gain that is there, it will be taxed at 12.5% plus surcharges, as I mentioned. And the other part to the question is that yes, a will can be obtained in will can be prepared, sorry, in Kenya, as I mentioned, while for the assets that are there in India. The only thing is that the basic essentials of a will need to be fulfilled.
So there is one question which is there in with regards to the TRC certificate being issued by the tax authorities of Kenya. So how we have been experiencing that thing. So if you can share your thoughts on that.
Right. So as I mentioned, the procedure of obtaining a TRC is already mentioned, and it's a physical request that needs to be raised. So many of the people that we are working with have already raised the request and are in the process of obtaining a TRC. So I think it is ideal to consult a tax professional who has experience in the Kenya tax laws, who has been practicing there, so that they can guide you for this process of obtaining a TRC in Kenya. Maybe we can take one last question before we end today's session. Thereafter,
Sure.
we are already always available for any kind of one-to-one session. I can see the question, which is about reinvesting to save on capital gains. Yes, on sale of property, you can invest in the bonds which are issued by these public sector companies, wherein capital gains to the extent of 50 lakhs of rupees can be saved by investing within a period of 6 months into these bonds to avail the exemption. Or if there is a residential house property, then there are other benefits which can be availed in terms of investing in other house property. Similarly, for other long-term assets, they can also be availed for the capital gain exemption if it is invested into a house property. There are several conditions to that. So I'll not go into each of them because it depends on case to case. But yes, there are routes to reinvest and the capital gain exemption.
Yeah, that's sir. Thank you.
All right. Thank you once again. And uh, looking forward to meeting you in connecting with you in future. Have a nice day. Okay. Bye.